Don't you wish there was a strategy that could lock in a cash return on your stocks while also producing potential returns of 50% or more? In this video, I'm detailing the options trading strategy I use to do just that. In fact, I just invested $25,000 in two stocks for an immediate 18% cash return and the potential to make 48% in just 1 year. We're talking stock options investing today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, we talk a lot about buying and selling stocks on the channel, but there's one investing strategy that I've been wanting to share for you for a long time now. I waited because stock options aren't something that every investor is going to want to use or even really needs. It's a little more complicated than that basic investing, but if you are ready for it, I'm going to reveal my favorite options trading strategy, one that I regularly use to get an instant cash return and total returns of 20 to 30% a year. Better still though, this is the best strategy you can use investing in those deep value stocks, those companies with falling share prices that you love, but you just aren't quite sure about the downside risk yet. So what I want to do in this video is give you a quick stock options tutorial first, describe these investments and what they're used for. We'll look at some of the pros and cons of options trading, and then I'm going to walk you through that strategy that I use with a real-life example of two stocks that I just bought and a $25,000 bet that could yield me 50% return. So options are just an investment that gives the buyer the right, but not the obligation to buy or sell that stock at a specific time in the future for a specific price. Now, there are two types of options, calls and puts. Call options give you the right to buy a stock at a certain price, while put options give you the right to sell that stock. Now, I know this can be really confusing here, but bear with me because we're going to look at a lot of examples. This is a call option for gold miner Eldorado Gold. The first thing you see here is that this is a January 2021, which is the expiration date here. This is the day that the call option expires, and I can either buy the stock or just let it expire worthless. Next to that is what's called the strike price. That's the price that I've locked in with this option. What it's saying here is that by buying this call option, I lock in the price of $10 per share for Eldorado Gold on January 2021. If the price of the shares is higher at that point, I can buy them for that $10 per share and immediately sell for a profit. Now lastly here though, you see the premium of $1.45 per share. This is the price that I have to pay to buy this call option. So buying a call option isn't actually buying shares of a stock, not yet at least. You pay that premium amount to buy the call options. Now the options then give you the right to buy the shares at that set price in the future. Now when January 2021 comes along, if shares of Eldorado Gold are above that $10 each, I have the option and can buy them for that price. For example, if shares are trading at $15 each, then I can buy for that $10 and have an immediate $5 profit per share. On the other hand, if shares are trading for under $10 each, say for $8 per share, then I could just let the option expire. I wouldn't use that option to buy at $10 if I could just place a regular market order and buy them for $8 per share. This is an important part of options trading. That premium that you pay is gone whether you eventually buy the shares or not. The hope is, of course, that the shares are above that strike price, the $10 per share, and the premium that you paid for the option, the $1.45 per share in this example. Now, I don't want to get too deep into the weeds here because I can already see some of the eyes glazing over out there. Stock options take a little practice to really understand what's happening, and you might need to read up on it a little bit more, but I want to get to that strategy that I'm using. I'll create another video on these basics, so make sure you subscribe to the channel and tap that bell notification to check those out. Now, investors use options trading for a couple of different strategies. It's not just betting on the direction of a stock price. Options can be used to buy into stocks at a discount, to benefit from a quick price change, or even reduce your risk and get that instant return in a stock, which is what we'll be talking about here. The strategy I want to show you is what's called the covered call strategy, and it's an option strategy where you buy shares of a company and immediately sell call options. So remember, a call option gives the investor the right to buy those shares at some point in the future. But for every investment, there is a buyer and a seller. So when you sell a call option, you're giving someone else the right to buy those shares from you at that price in the future. And if you're thinking, why would I give someone else this right? It's because they pay you that premium amount when you sell them that option. Going back to our Eldorado example, if we sold this call option to someone, they would pay us that $1.45 per share immediately. The shares are trading for around $7.60 each as I record this, so I'm collecting $1.45 for every share I own, or a cash return of about 19% on this investment. Now, if shares of Eldorado went up to $10 or more by the time this option expires, that investor would use that call option to buy them off me for that strike price, that $10 per share. I'd make the additional return from where the shares are trading at today to that $10, but that return would be capped on that option. On the other hand, if shares of Eldorado didn't make it to that $10 each by the end of that call option, the investor would just do nothing. They wouldn't buy my shares for $10 each. I would keep all those shares and the $1.45 premium for each option. Again, a lot to take in if you're just starting out with options trading, so I'm going to take you through a few more examples here. I'll show you the actual covered call options that I use in my portfolio. Then we'll cover the pros and cons and how to set up this kind of investment. Here we are in my E-Trade account. This is actually one of 4 accounts I have on E-Trade, but this one is where I do most of my trading. Here you see that I've used this strategy with Eldorado Gold, ticker EGO. Now, I started buying into Eldorado early in 2018, eventually putting together an investment of 10,000 shares at an average price of $6.46 per share. Now you see here that I've sold 50 contracts of those 2 call options, one at $6 strike price and another at a $7 strike price. An important note here though is that options are sold in groups of 100 shares called a contract. So those 50 contracts are options on 5,000 shares. That's 50 times 100 shares each. So I sold 50 call option contracts against 5,000 of my Eldorado shares for that strike price of $6 for $1.10 each. The other set of 50 call options at that $7 strike price, I sold for 81 cents each. Now that means altogether I collected $9,550 from investors that bought those call options from me and locked in their share prices at $6 or $7 per share. If you add up these 3 positions between the shares that I own and the call options I've sold, I have a net gain of $9,500, and part of this is the value that I still have in that call option. That's about a 12% return on the money that I've invested on top of $15,000 that I collected in selling call options in 2018. Remember, when I bought those shares in 2018, I sold call options against those as well and collected that premium, but because the share price didn't go up to where the strike price was on the calls, the options expired worthless and the investor didn't do anything. I kept that $15,000 and the investor paid me on the options and kept the shares as well. So if these call options are used to buy the shares from me in January 2020, which it looks like they will be with those shares trading or above the strike prices, then I'll have made a combined $24,550 on the investment. That's about 38% over the last 2 years, which is about 17% annualized. Now I want to walk you through 2 investments I just made on shares of Pinterest and Uber that could pay off as much as 50% each over the next year. So if we scroll down here, we see I bought 600 shares of Pinterest and 600 shares of Uber recently. The Uber shares were actually bought in 2 days, first on that big disappointment in earnings, and then on the next day when the shares fell again on that lockup expiration. Against those shares I bought, I sold call options for that covered call strategy. Here I sold 6 contracts of Pinterest call options at that $25 strike price expiring in January 2021, and I collected $3.75 for each share. That means I collected $2,250 from an investor to sell them the right to buy my Pinterest shares for $25 in January of 2021. For the Uber position, I sold 2 contracts at that $35 strike price and collected $3.38 for each share. Then I sold 4 contracts, and remember that represents 400 shares. I sold these on that $40 strike price and collected $3.26 per share. Total here, I collected $1,980 in premiums for selling the call options to these investors. Now, one of the things I love about this covered call strategy is that you collect an instant cash return on your investment, and you can really look at this in one of 2 different ways. For those Pinterest shares, I paid $20.54 per share, but got an instant cash back of $3.75 each by selling the call options. So in effect, I actually paid just $16.79 for those shares, which is an 18% discount to where they are trading now. So you can either think of that premium you collect as a cash return on your investment, like a really sweet dividend, or the ability to get shares at a discount. Now let's look at what could happen with this Pinterest position. If Pinterest rises to $25 a share by January 2021, that investor is going to buy my shares for that price, and I'll be out of my position. I'll sell the shares for $25 each and keep the $3.75 per share for each call option. Now this is one of the risks of covered call options trading, but one that I think that you'll agree is well worth that risk. If Pinterest shares surge to $40 each by the end of that call option, I still have to sell them for $25 a share to that investor. That's why they bought the call option, to lock in that strike price. Now, if that happens though, look at my total return here. I got the shares for $16.79 each by collecting that $3.75 premium against the share price of $20.54. Selling the shares for $25 each means a 49% return in the 14 months to January 2021. That's a return I can live with, especially considering the alternative here. If shares of Pinterest don't head to that $25 or higher by that date, I keep my shares. The investor does nothing with their call option and I keep the premium. I made that 18% cash return, or the 18% discount on the shares, whichever way you want to look at it. Better still, I can sell another call option to another investor, collect the new premiums, and this just all keeps going on and on. So I'm here collecting a huge return in 1 year, upwards of 50%, or I get cash returns every year selling these call options and eventually get that higher return when the shares do bounce higher. Now I want to show you how to set up this covered call strategy, as well as dig into some of the pros and cons. But first, I want to get your feedback on this. The covered call strategy is just one thing you can do with options trading. In fact, I used to spend a lot more time using many of these other strategies called condors, butterflies, and even naked positions, which unfortunately are a whole lot less exciting than they sound. Anyway, question is, do you want to see videos on these other types of investing strategies? Some of these are higher risk, but can also mean higher returns as well. So scroll down and let me know in the comments whether you want to get into these other types of strategies. So just a few pros and cons of this covered call strategy before I show you how to set it up and how to manage it for those returns. Now, pros of that covered call strategy is that instant cash return on your investment. You effectively lower the cost that you pay for a stock, so it can be a great way to pick up shares at a discount. This also helps limit your risk in a stock. I can see those shares of Pinterest fall by another 18% before it hits that price that I paid. This is a great income strategy and one that you can use if you're not sure about the upside on a stock. For example, if you own shares of a stock for a long-term investment, but maybe you're a little worried about the downside over the next year, you can sell some call options and protect your investment from a 10 or a 15% drop. There are risks to the covered call strategy though, and I don't want you to think I'm promoting this as some miracle investment strategy. Most obviously is that you're capping your upside returns using these covered calls. If shares of Pinterest surge higher over the next year, I still have to sell them for that $25 each to that investor that bought the call options from me. I've capped my return at 48%. Now, another possible risk of covered call options trading, though, depending on how you want to look at this, is that if the shares price keeps on falling. This is what happened to those 10,000 shares of Eldorado Gold I bought in 2018. The share price kept on dropping, so even with that cash collected on the call options, I was still looking at a little bit of a loss. Now, eventually, I made it back up because the shares rebounded and I was able to sell more covered calls against that. Setting up a covered call option strategy is really easy. Any stock trading platform is going to have options for the shares where it's available. You click through and see all the dates for which the options are trading, and this is usually monthly out for the next few months. There's also these longer dated call options expiring in January. I like to use these January options because they're usually more liquid, meaning there are more investors buying and selling those options. That's so I can get a good price on the options and can buy or sell quickly if I want. So you click through to the date you want and you can see all the different strike prices. Here we see you can buy or sell options on Pinterest shares at a share price from 13 to 27 per share. And actually there are more strike prices if we open the table up further. I usually like selling covered calls for around 20 or 30% higher than that current price. That means the shares can run 30% higher before I get my shares called away with that options contract. And you can do some quick calculations here to see what your returns are going to be on those different stock options. If I were to sell these call options with the $25 strike at $3.40 each, I would collect a 17% cash return or lower my price to $16.97 for those shares of Pinterest. If I then sold for that $25 strike price, that would mean a 47% return over the next year. If, on the other hand, I were to sell the calls at that $20 strike price, I'd collect a $3.90 a share for that instant 19% cash return. That would cap my total return at around 40% on the shares if I sold them for that $20 each, but I'd also get a little bit more downside protection with this lower strike price. Now I'm going to go with that $25 strike price and click through to the order. Now this gets me to the screen to just buy the call options, but I want to do here is what's called a buy right. That's where I'm buying the shares and at the same time writing a call option against it. Depending on your investing platform, this is either going to be called a buy right or a covered call. So clicking through here, I can set this up. I put in my stock order to buy 500 shares of ticker PINS. That's shares of Pinterest. Remember, these have to be in hundreds because we're going to be selling options contracts and each contract is worth 100 shares. Then I go down here to the options trading part of the strategy. I look in this drop down for sell open because I want to sell options against my open position of stock. Then I would make this for 5 contracts against that 500 shares of stock and make sure these are call options we're selling. I pick my expiration date, which we wanted to sell these January 2021 call options and that $25 strike price. Now when you set this up, everything is going to populate on the side here with that current strike price as well as the bid and ask prices on the options contract. One thing we didn't talk about yet was that options contract have a bid price for buyers and an ask price from the sellers that can be miles apart. When you go to do this strategy, you want to get a good price for your options, so you're going to be placing what's called a net debit order or a limit order. In effect, you're telling the broker to place your order at a certain net cost for these shares. Now, I usually use about the midpoint between the options bid and ask price, or maybe a price a little bit better. So here we have buyers willing to pay $2.75 a share for the Pinterest call options, and we have sellers that want $3.80 per share for the same contract. And we see that the last contract traded was for $3.40 a share. So just using this last price of $3.40 per option and the $20.41 per share on Pinterest, we'd have a net cost of $17.01 if we were to buy the shares and then sell the call option against it. I would normally round this down, so put in an order box that I want a net debit here of $17 a share for those 500 shares of Pinterest, selling the 5 contracts for that covered call strategy. So if I click through to preview my order, I'm investing $8,500 to buy these 500 shares and getting that $3.40 each back as a cash premium from that options investor. If that trade goes through, I'll get an instant 17% cash return from the call options. If the share price runs to that $25 or higher by January 2021, the call option buyer is going to use those contracts to buy the shares for me, and I'll make that 47% total return. If the shares don't reach that $25 each, I keep the stock and the premium that I collected and can turn around and sell another 5 options contracts to collect more cash. Click through to the video on the right to see my 5 favorite tech stocks of 2020. 5 tech names to buy whether you use this covered call options trading or not. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.